You're watching Mirror 7 News. Stay informed, stay ahead for more news.
When it comes to dividend investing, few funds get talked about as much as the Schwab U.S. Dividend Equity ETF, better known by its ticker symbol SCHD. It has built a reputation as one of the most popular dividend-focused ETFs on the market, with nearly $70 billion in assets under management. But lately, the conversation around SCHD has taken on a new dimension, as recent Trump administration policies, specifically tariffs and tax changes, are starting to shape how funds like this perform. SCHD is built to follow the Dow Jones U.S. Dividend 100 Index. That means it invests in companies that have raised dividends for at least 10 consecutive years, which already filters out weaker or inconsistent businesses. But it doesn't stop there. Each company is scored based on financial strength, return on equity, dividend yield, and even the pace of dividend growth over the past 5 years. Only the top 100 make the cut, and those stocks get included in the ETFs. So the idea here is to strike a balance between quality, growth, and income, all while keeping costs very low. The expense ratio is just 0.06%. Now, where things get interesting is how current policy changes are playing out. Tax cuts have been designed to benefit companies with higher effective tax rates and a stronger domestic focus. That description actually fits many of the firms inside SCHD, so at first glance, they stand to benefit more than tech-heavy funds like the S&P 500 ETF, that is SPY. But at the same time, tariffs have been ramped up, and that creates pressure on companies that rely heavily on imports, exports, or global supply chains. Since SCHD leans more into consumer staples and energy, those sectors could feel the squeeze in ways that offset some of the tax advantages. This tug-of-war between tax relief and tariff headwinds means investors shouldn't expect smooth sailing. Relative underperformance compared to broader market indexes has already been noticed, and some analysts believe it may continue in the near term. Still, SCHD remains attractive for long-term income seekers because of its steady dividend yield, currently sitting around 3.8%. That's well above the market average, even if not the absolute highest yield you can find. So is SCHD more of a value play, or does it lean toward growth? The truth is, it doesn't firmly pick a side. The index is built to capture both financial strength and consistency appeal to value investors, while ongoing dividend growth appeals to those chasing growth. In practice, that makes SCHD a middle ground option. It may not satisfy purists who want pure growth or deep value, but for investors who want a reliable dividend payer with balanced exposure, it's a compelling choice. In the end, SCHD is less about dramatic moves and more about discipline. Its dividend track record, combined with its careful stock selection process, has created a product that income investors can rely on, even as political and economic winds shift. Trumponomics may bring volatility, but for those willing to hold on, SCHD continues to deliver on its promise: steady dividends in uncertain times. Stay subscribed for more videos.